All right, welcome to part two of our discussion of changes in the accounting equation and the financial statements. So we're going to return to the concept of liquidity as I give you some tools that we use in accounting to measure the financial health and the changes on the accounting equation that happen based on the various events that happen in a business. So the first concept, we're going to return to the idea of liquidity. And now we're going to look at some tools to measure just how much liquidity we have. Remember, liquidity is the ability to pay our bills and be financially flexible. So we're going to measure the liquidity with two ratios directly. Current ratio equals total current assets. So we're going to look on the balance sheet. We're going to see all the current assets. Now we understand why it's so important we have everything in the right place, because this is an important measure of how well we're doing. And divide that by the total current liabilities. So we need to know what assets we have and which ones are current. And we need to know which ones are current liabilities, which liabilities. So current assets are available in 1 year. Current liabilities payable in 1 year. Quick ratio is going to be the quick assets divided by current liabilities. So quick assets is a smaller measure than current assets. It's everything more liquid. So remember, balance sheet is listed by liquidity. Everything at the top is more liquid than at the bottom of the asset list. We're going to start at the top, and we're going to add up until we hit inventory, and we're going to stop right above inventory and add those up, and that's going to be our quick assets. Everything more liquid, and divide that by current liabilities. Both of these numbers are just ratios. Don't try to make them percentages. Don't make them, you can just put the decimal in there, 1.7, something like that. The higher the ratio, the more liquid and more financially flexible the company is. However, if it's too high, if they have too many of these assets, then they're just probably not being very efficient. And they're sitting around with extra cash, extra current assets that they are not utilizing as well as they could. So you want them to convert some of those assets into more effective assets like equipment and buildings and things like that. So what happens when you change things? Since we're talking about changes, here's just a summary of what happens to these ratios with changes. If you change the assets or the liabilities or so forth, and you probably aren't going to want to memorize these, but get familiar with these changes. So I set up a little spreadsheet that kind of illustrates what we're talking about. So the formula is current assets divided by current liabilities. I just put some numbers in here, and I put my current ratio here as a calculation in Excel. This is why Excel is so valuable. But you can use another kind of a program. You can use Google Sheets, whatever. It will all do the same thing. So if I make my current assets go up 100, you can see what happens. I've created a formula that makes my current assets go from 700 to 800. Nothing changed on the liability side. And so my current ratio went up. So anything that makes current assets go up and current liabilities stay the same, then we're going to have an increase in the current ratio. Let's say that the current liabilities didn't go up 100, they went up 50. Okay, you'd still have an increase in the current ratio. All right, because the current assets went up more. So what if it just makes my current liabilities go up? Whoops. Okay, we got the math going there. Let's go 500 here. We'll make a big difference. You see the current ratio goes down if current liabilities go up, and nothing changes on the current assets. You can see even if current assets goes up some, but current liabilities go up more, then it will still go down. What if they go up the same? So, for instance, we buy inventory on credit. That's a current asset. The current asset is going to increase. It's a liability because we bought it on credit. We're going to have to pay it later. That's a liability, current liability. So we got a current asset, a current liability. They're both going to go up by exactly the same amount. And I'm telling you that most of the time you're going to want to set it up this way. If you try to think it through, you might get the right answer, but if you test it out, you're almost guaranteed to get the right answer. Okay? And it kind of depends what your current ratio is already for when it's the same. So when it's the same, in this case, your current ratio went down. It went from 1.75 to 1.5. So that's why it's a good idea to do this kind of testing when you're not sure of what the result is. If you know the formula and you know what is changing, assets or liabilities, then you should be able to figure out what the change will do to the current ratio or any of the ratios we're going to talk about in just a minute. So, some more ratios to learn. This is measuring how good we are at collecting our accounts receivable. Remember how important that is. If we want the cash come in so we can invest it in other things, we need to collect it from these customers. And so we try to measure that to see how good we are at that. And the way we do that is two things: accounts receivable turnover and days sales and receivables. So we take our sales off the income statement and we divide it by the average accounts receivable. Now when we say average, we're taking the beginning of the year plus the end of the year and dividing it by 2. So you add it together, divide by 2, that's your average. So sales goes on top of your ratio, your accounts receivable average goes on the bottom, and that tells you the number of times we collect our money per year. So don't label that a percentage, label it number of times. So that's the number of times. So your sales off the income statement, accounts receivable off the balance sheet. Once you have that number and you want to know how long it takes on average to collect our receivables, we take 365, that's the number of days in a year, to divide it by your accounts receivable turnover. That tells you the number of days it takes to collect your accounts receivable. Okay? So on the inventory side, it says before we can collect money from our customers, we have to sell the inventory. So it's very important that it is turning over. What we mean is selling through, and so you're getting rid of it in a reasonable way. To do this, the top number is cost of goods sold for the year, not sales, cost of goods sold. And then on the bottom, you divide by the average inventory. So it feels kind of like the same thing we did before, but instead of using accounts receivable, we're using inventory off the balance sheet, current asset. And we're looking at how many times per year we're selling all of our inventory. The more times per year you sell it, the more liquid you are. The easier it is to turn it into cash. The less likely it is to go obsolete or it to be broken because it's selling quickly enough that you don't have those worries. Days in inventory is just like days in sales and receivable, 365 divided by inventory turnover, measured in days. So label it days when you calculate that. So you want to have these numbers high, but if it's too low, if you're not collecting your money or you're not selling your inventory, then it's not doing you much good. It's sitting there, it could be obsolete. Customer could be getting into trouble financially and therefore not pay you. However, if it's too high, that means you maybe have too little stock and you don't have enough inventory. Because remember, inventory is on the bottom of this. So if you make inventory really small, you'll have very high turnover because the cost of goods sold at the same level. Inventory goes down considerably, then your turnover is going to be higher. But that may mean you have too little inventory and your customers get ticked off because you never have anything that they need. And maybe you always collect your receivables and you collect it very fast, but maybe that's because you only sell to a few customers that can for sure pay you, and you're missing out on customers that might be slower paying but would still pay because you're being too stingy. Okay? So again, it's not necessarily that high is always better. There's a balance between the two, just like with the current ratio and quick ratio. The last area of ratios that we're going to learn about. So we've learned liquidity, then we have the turnover ratios that affect indirectly liquidity, and then profitability. And these are the ones that probably more people are familiar with. So the first measure that we're all familiar with, because we've talked about before, revenue minus cost of goods sold equals gross profit. Now we take that gross profit and we divide it by that revenue again, or the sales, to equal our gross margin or gross margin percent. And that is a percentage. In fact, all of the profitability measures should be calculated as a percent. So that's the first one. That's kind of the percent we made over what it cost us. Remember, cost of goods sold is what the inventory costs us, revenue is what we sell it for. So we're looking at how much we can make just if we, only thing we're worried about is selling our inventory for more than it cost us. Now, of course, there are other expenses. So the second measure is we take revenue minus cost of goods sold minus other expenses, but not usually taxes. That gives us our net operating profit. We take that number, we divide it by their sales or revenue again. So you notice a kind of a theme between these two here. That's profit margin. We don't call it gross margin because that's already been used. Profit margin or net profit margin, you'll see sometimes, is usually also a percentage. And then the last one, same number, net operating profit, revenue minus cost of goods sold minus other expenses other than taxes. Now we divide it by something off the balance sheet. So now we're taking the net operating profit from the income statement. We're dividing it by the average total assets, beginning of the year plus the end of the year, divided by 2. If you have 2 years, if you don't have 2 years, you can always just use the assets for 1 year, the year that you have the income statement for as well. That's referred to as return on investment, or you'll also see it referred to as return on assets. Just a little warning, there are no GAAP rules, no FASB to set how you calculate these ratios. So there's sometimes that there's a little tweaking in the names and things like that. So return on investment, return on assets, depending on where you're looking, can be used interchangeably. That is also a percent, typically. All of those are measuring just how efficient we are on the income statement in making net income. The basic idea is you can't really say that profitability can be too high. Most companies can't get it real high, or their customers are being taken advantage of. If you're making 80% profit margin, you're making so much profit, someone's going to realize that that's the case, and they're going to come in and they're going to sell the product lower than what you're doing it for. unrealistic profit percentages aren't going to last because competition will take that away from that. That's the beauty of competition. But your goal is to make it as high as possible. So you're either trying to raise revenue, sell it without raising costs, meaning sell what you have, the same stuff to more people or for more money, raise the price on it because you make it more valuable. Okay. Without having to pay more for the product and without driving away customers, because if you keep raising your prices, they'll go somewhere else. Unless you can convince them that there is something valuable about your product that makes it more valuable than anyone else. Another way to improve profitability is you got to just make the costs go down. Sell it for the same amount, but your expenses are lower. All right? And not compromising quality while you do that. So maybe you find a new way to produce something, same quality, but a lower cost. Okay? Because lower quality typically makes customers mad, at least over time. You may get away with it for a little while, but they catch on and then they'll go somewhere else. The other thing when you're looking at return on investment or return on assets is you can make the same amount of profit, but do it with less assets, meaning you find more efficient ways. Maybe you use less buildings or less equipment, and therefore you can sell off the unused equipment. But you're still able to make the same amount of product and sell it for the same cost, but you do it with less stuff. And that can increase your return on investment, that last profitability measure. So the key with these ratios is knowing where they come from, where to find the information on the financial statements, which is why we've spent so much time talking about the definitions of the various items, where they go on the financial statements so that you know where to go to find them, calculate these ratios, measure these items. And this is the basis by which investors compare one company to another. Because by turning it into a ratio, it doesn't matter whether the company's big or small, or they operate in the United States. It could even operate with different currency. The ratios just compare numbers. So it doesn't matter if it's in euros or pennies or dollars, or if it's millions or billions or thousands, you still can see the same picture, which is why they're used so readily and why we want to know how things will change those ratios. So if you know something's going to increase gross profit, you know that it's going to, and sales are going to stay the same, then you know that it's going to increase your gross margin percent. All of these work together. So that is how professional investors and others make judgments about companies, as they look at these ratios and how they change based on what the decisions are made by the company.